Ever wonder if the stock you're thinking of buying is at a good price, or if it will go up or down in the future? If there was only some secret way to know if you're getting a bargain, you might be in luck because a lot of investors use the magical PE ratio. The price to earnings ratio measures the relationship between a company's stock price and its earnings per share of stock issued. You may interchangeably hear people refer to the PE ratio as price multiple or earnings multiple. The PE ratio is found by taking the stock price per share divided by the earnings per share. Companies that have negative earnings do not have a PE ratio since they have no positive earnings. So if you've ever noticed stocks like Tesla or Beyond Meat have no PE ratios next to them, that's because they are currently unprofitable. Earnings per share can be calculated by subtracting a company's preferred dividends paid from its net income, and then dividing the result by the number of shares outstanding. In this made-up example, two companies, M&M's and Hershey's, EPS is calculated as follows. To get their respective earnings per share, which are both considerably lower than the industry EPS. Generally, the higher the earnings per share, the better the value of your share in the company. You will probably never need to actually calculate these formulas by hand, but it is important to understand how they are calculated. Otherwise, you won't be knowledgeable on what the ratio is really saying. Now that we know how to calculate the earnings per share, we can figure out the actual PE ratio. Stock A here currently trades for $30 per share. The PE ratio would simply be $30 divided by $2, or 15 for the PE ratio. The company's stock price reflects the value that investors are currently placing on that investment. A stock's PE ratio indicates how much investors are willing to pay for every dollar of the company's earnings. For example, stock A is currently trading at a multiple of 15. The interpretation here is that an investor is willing to pay $15 for $1 of current earnings. There is a difference between price and value. Price is easy to know, as that is just simply the supply and demand for a stock, aka the stock price. Value, on the other hand, is not as easy to calculate. It is the true value of the stock, and that is not written down anywhere, and it is extremely subjective based on the investor. Value is measured in many different metrics, and no one way is correct or wrong depending on the person. But I personally see value as the difference between the price and perceived benefit the consumer will get. Price is the same for everyone, but value is very intangible. Let's imagine me, a US resident, versus someone in a developing country that still only uses cash. We both have the same price to pay for MasterCard stock at $279, since that is what it would cost for both of us to own a share. However, our value is a little bit different because I envision a world where we are cashless and simply use cards. The other individual probably wouldn't value MasterCard as highly as I do because they don't see the potential of a cashless society. It's possible I'm overvaluing MasterCard and they are undervaluing it, but both get figured into a PE ratio anyway. A PE ratio by itself might not scream sale, so investors also like to use forward PE and trailing PE to give better context. A disadvantage of the PE ratio is that stock prices are constantly moving, while earnings tend to remain fixed for periods of time. Analysts attempt to deal with this by issuing or using the trailing price to earnings ratio, which uses earnings from the most recent 4 quarters rather than earnings from the end of the last fiscal year. Trailing PE is basically taking the share price divided by the total earnings per share over the most recent last 12 months, not just the earnings per share at the end of their most recent fiscal year. The forward PE ratio, on the other hand, divides the current share price of a company by the estimated future or forward earnings per share of that company. It may be hard to get future earnings per share numbers, but this is usually provided by the company in their quarterly earnings reports and can be found for free on sites like Yahoo Finance. High PE ratios suggest that investors believe there is higher earnings for the company in the future. But be warned, it is extremely hard to value future growth in the price of a stock. Stocks with a high PE ratio could mean that the stock is overvalued, and investors can lose money when the stock doesn't meet earnings expectations. A low PE ratio could indicate the stock is trading below market value or what it has historically traded at. The average PE ratio of the market is around 20 to 25, but know this varies heavily by industry, so be sure to check that out. What I like to do is to go on a site like TD Ameritrade and look at the stock's PE ratio. They also provide what the industry average PE ratio is. This will give you a better idea if a stock is overvalued or undervalued based on its peers. So, the $1,000,000 question, does PE ratio matter? I would say yes. It does matter because it allows one to get a quick gauge on what the company is worth compared to earnings and share price, but it has one very critical flaw, that is, it is impossible to accurately project future growth, which is built into share prices. That's the reason why investors put a lot of money into companies like Tesla that currently don't make any money. They have a vision that the company one day will be profitable, but that's not something you can say with 100% certainty. The PE ratio should not be the only metric you use, but the first out of many, including how the company's balance sheet is doing, its economic moats, any patents it might have, the company's management, team, and their future vision, their performance during the recessions, and if their products or services will be affected by future technology. I am a small-time YouTuber. The best way you can show your support is to leave a like for the YouTube algorithm, comment what factors you look at when analyzing a company. I respond to all comments, by the way, and subscribe to the channel as I put out more animation videos on personal finance on a regular basis.